Thanks a lot. So we're going to spend a little time here talking about what the market, what the option market is saying about direction of the stock market. Just a little background on our company. We have newsletters, we manage money, and we also do a certain amount of option education, including mentoring. So covering options pretty much the whole way. In the money management, we're a CTA and an RAA for specific option-oriented accounts. I'll come back to this later. We will send you PDFs of the presentation by PDFs. I mean, you'll be getting one that's color and then one that's grayscale in case you want to print it out. You won't use up all the ink in your printer or font, whatever. This is the website where you can go to get the offer. I'll talk about that more later. So we're going to look at these various things, plus a couple of other things. We're right now in a very bullish seasonal period that begins with tonight's trading, so that will be something very timely. But other than that, we'll look at the chart of the S&P 500. We'll look at what equity-only put-call ratios are saying. We'll look at market breadth, where we have an option-oriented way of looking at that. And then we'll look at what VIX and the VIX derivatives futures are saying about the market as well. So I have one important rule with the corollary, and that is oversold does not mean buy. So really not oversold on much of anything right now. But when the market does get oversold, it can continue to fall for quite some time. The corollary is that overbought does not mean sell. So we were overbought for most of last summer, but the market kept going higher into the fall, and even then it really didn't go down. A lot of stocks that were you might consider to be overbought continued to go higher. So we wait for actual confirmed signals. In an overbought condition, we're looking for sell signals. In an oversold condition, we're looking for buy signals. So here's a long-term chart of the S&P. As pretty much everybody I think knows where this has been going, but after we made these the tariff tantrum lows last April, we've been off to the races to the upside, and there's some pretty strong support at 6,500, this middle line right here, and then also the December lows at 6,720 is an important support point as well. We haven't had a really significant correction since that April decline. I mean, what we had there in November was a little bit of a correction, but not too much. If we zoom in a little bit, we can see that, you know, once we finally exhausted the heavy buying through this last summer, we went into this trading range here. It's kind of delineated by this green box, and it's 400 points high. We bottomed out at around 6,500 a few times. That support held there each time. Then we rose up here. We've had trouble with the 6,900 area. Even today, still, we've hit these blue lines. So we've kind of broken out of that box a little bit to the upside, but it's really not what I would call a strong breakout. We've only had, I don't think we've had any sequence of 3 new highs in a row. We've had two new highs in a row. But, you know, so we're still looking for what I would consider to be a really strong breakout over this level. There is support at last week's lows around 6,800. That's where we fell back when there were the rumors of, well, not rumors, but fears of more tariffs on Europe due to Greenland. Anyway, the height of that box is 400 points. So there's an old, actually very old technical saying that says if you've been in a trading range and you break out of it, then you're going to go the distance of the range. So that would be 400 points. The top of that box is 6,900. So that target would be 7,300 in that sense. On the other hand, if we break the December lows, that would be very bearish. And we've written a recent article on that. It's pretty conclusive that anytime we've broken the December lows early in the next year, it's a big problem. The Stock Traders Almanac shows that going even all the way back to 1950, when those December lows are broken, if they are broken, the market will fall an additional 10% or so before it recovers, sometimes much farther. So that's something, we're kind of keeping an eye on. That would be quite bearish. But on the other hand, if we can finally get through 6,900, well, it'd be more like 7,000. Now we touched 7,000 today, fell back from there. But if we were to like put on, a nice push here to get to the upside, we have some more near-term targets in hand. Now, another thing we do with an S&P chart is we draw modified Bollinger Bands on the chart. Modify to the extent that we're using the realized volatility that Black-Scholes use in the Black-Scholes model. And because we're an option-oriented firm, we need our realized volatilities to line up with the implied volatilities that are coming out of the model. And so we use that same thing for drawing Bollinger Bands around the S&P chart. And so here's the current chart. And right now, that upper band is +4 standard deviations right there. That band is around 7,100. So that could also be considered a target. You could going back here, we've had a few signals about, not one recently. Last signal we had was this a sell signal back in October, and we got a quick success out of that, either bottoming there or over here in November. And since then, S&P has remained inside the bands. So you can see the bands are starting to converge upon each other here now as realized volatility is dropping. You can see the lower bands and the upper bands are not here's the lower bands. Lower bands and the upper bands are not too far apart. So it's possible we could get a setup on a signal there. But right now, there is no signal from these what we call McMillan volatility bands or modified volatility bands. So we can, we have a track record of these in our newsletter going way back, and it's been a pretty successful signal over time. So we'll just have to see when the next one occurs. We can apply the same logic, the same drawing of these modified Bollinger Bands to any chart, any futures, any index, any ETF. And we have a subscription service for that, which tells you daily where we're getting new signals. This is how it looks. It runs off a trading view, and it puts these little arrows for sell or buy on the chart, and when they come up. So this is exactly how it looks, with like a green arrow down here for a buy, a red arrow for sell. And that's the S&P chart, same one we were just looking at. There's a couple of other ones. Microsoft just gave a buy signal here a couple of days ago. Now, Microsoft earnings are tonight, and so that could throw a monkey wrench into the system. But that right now, let's see, Microsoft is down a little bit on the earnings. Well, a little more than a little bit. It's about 25 points. So that might be a good point to come in and buy. The Apple is another one. Again, Apple also, I believe, is reporting tonight, or maybe it might be tomorrow, but it's certainly this week. So again, we have a buy signal from this system for Apple. Anyway, let's move on. Put call ratios. So put call ratios are a contrary indicator discovered or invented by Marty Zweig back in the 1950s, when he used to get put and call data from the ads that ran in Barron's every Sunday that were published by the put and call dealers. Today, we use the equity only put call ratio. That's all stock options that trade, which is hundreds of thousands of them, even millions sometimes, to predict the broad market. But the theory is this. This is what Marty discovered in the first place, and it still holds true, is that if there's too much speculating in the buying of puts, then the market will go higher. And if there's too much speculating in the buying of calls, then the market's going to go lower. So defining, of course, what too much is the crux of the problem. But typically, we publish about 1,600 or more put call ratio charts on our website every day in an area called the strategy zone. And we publish the stock price chart as well as the put call ratio chart, because they should have an inverse pattern to them, like is shown here. So, for example, when we're looking at this particular chart, we'd see that as the stock is going down like this, then people are buying puts and forcing the put call ratio to go higher. But eventually the put call ratio forms a local maximum, and that's a buy signal for the stock. So then the stock starts to go higher. As the stock's starting to go higher, people are buying calls. That's forcing the ratio lower and lower until you finally come to a local minimum. And when you get a local minimum in the put call ratio, that's a sell signal for the stock. So that's the theory. This is not a current chart, but this on top is the S&P 500 index. And on the bottom is the equity only put call ratio. Again, all stock options that trade. You can see the inverse symmetry that exists here. So that's why we use the equity only put call ratio to predict the broad market. So where do we stand? So this is the equity only put call ratio, which is called the standard ratio. It's just the volume of puts divided by the volume of calls. And we had a local maximum in December, and we got a bit of a rally, but it was kind of a halting rally, and it almost looked from that point on like we were then going to have a local minimum there. And I actually did put a sell there because that local minimum was in place for 10 days, but really didn't produce much of anything. And now the ratio is moving lower again. So it's back on a buy signal for this ratio. Last October, it got very low, the lowest it had been in 5 years, 4 years, I guess. And that was a sell signal. Again, we had some sell off there in November, but not a very big one. Now, as computers came along, we were able to calculate what's called the weighted or dollar weighted put call ratio, measuring the dollars being spent on calls versus the dollars being spent on puts. And it gives signals in about the same place, but sometimes they're a little bit clearer signals. So in this particular case, once again, we had the local maximum buy signal in October. This sell signal here is sharper than the one was in the previous chart, but now it's rolled over to, again, a local maximum giving us a buy signal. So that's also on a buy signal. And these will remain on buy signals as long as these ratios are continuing to decline. It's sometimes we were seeing, especially last year when the market first made new highs, that traders were buying puts as protection. That's sort of gone by the wayside now, but we update these things daily, and they're in all of our newsletters and our publications. So what do we trade when we have these signals, a Bollinger Band signal, a modified Bollinger Band signal, or a put call ratio signal? We trade SPY options because we're trading the broad market there. And typically we trade an option that's slightly in the money because I want to have a high delta on the option that I'm owning. I don't want to play it as a lottery ticket. I really want to play it as, I think I'm going to be right on the underlying, and I want to be right on my option then too. So we buy slightly in the money, maybe 1 or 2 strikes, and not too far out in time, couple 3 weeks, and that gives us a fairly high delta. So the option will respond quickly if the stock goes in our direction. If we're doing a little bit longer term trade, like a put call ratio, we might buy an at the money option, but even that has a delta of like 55. So that means it'll move 55% of this distance that the underlying SPY moves. Now, a lot of times on TV, you'll see there's spread almost every trade they do in options. That's really not efficient, and you really shouldn't do that. Typically there is a time to spread, and that is when the options are very expensive in terms of their implied volatility. We publish free volatility data on our website every Saturday, and it gives you the implied and historical volatilities of everything that trades options, and some moving averages of those things. And you can easily tell there if the options on a particular stock or whatever are expensive. For like right now, options on gold and silver ETFs are very expensive because the things are just roaring to the upside. But typically they're not. So you don't want to spread if you don't have to. Proponents of the spread will say, well, you're risking less. That's not really true at all. If you do a spread, and by a spread I mean what they're recommending is you buy a call at this strike if you're bullish, and then you sell a call at this strike. So, you know, your spread makes money all the way up to the high strike, and then after that, you cut off your profit potential. Well, that's not really a very nice thing to do to yourself, cut off your profit potential. Now, if the options are expensive, it makes some sense. But just because you think you're risking less is wrong, because you're risking 100% whether you put up the money for a bull spread or buy a call. Now, you might be risking a few less dollars, but it's still 100%. You can always adjust for the dollars, you know, instead of buying 5 bull spreads, only buy 4 calls or something like that if you want to equal out your dollar risk. But your percentage risk is 100% in both cases. So we recognize this, but sometimes options are expensive, especially in SPY, especially in the longer term contracts. So we do sometimes spread. Now, you can mitigate the negative aspects of spreading, that negative aspect being cutting off your profit potential. You can mitigate that in 2 ways. One is widen the difference in the 2 strikes, and 2 is roll if this underlying roll rises to the short strike. So first, widen the difference. So right now, if we're looking at SPY, if I'm going to buy a SPY option just expiring on February 13th or sooner, I'm not going to bother spreading. But if it's expiring on February 20th or later, then I will spread. And calls, I'm going to spread 15 to 20 points wide on the bull spread. But if I'm doing puts, I can afford to go 35 or 40 points wide. That has to do with the difference in implied volatility of out of the money puts versus out of the money calls. Now, what do I mean about rolling if the short strike is hit? So today's SPY was around 695. Let's say you were bullish and you were going to set up the February position. So you buy the February 695 call and you sell the 710 call. So 15 points difference between the 2 strikes. And you're fortunate enough to see this SPY then quickly trades up to 710. Well, that's nice. But now you've just about maxed out your position. Here was your original position, and this being 710 here. And now you've risen all the way up to 710. And yes, there might be a little bit of room left in that, but not a lot. So sell that spread, take the profit on the spread you bought, and buy a new spread if you still want to spread. Again, with 15 points wide, but raise both strikes by 15. So what you end up doing is now you've opened up the upside a little bit more. If it keeps going up, you can make more money. You're not just locked off at the 710 level. So this is sort of a graph of the original spread, 695 to 710 is this black line here. This line right there, so the straight line is where you'd be at expiration. The curved line is where you are during the trade. But once you get up here to 710, you can see there's not that much left. So now you sell that one and you move into the red one, 710, 725. And now you can see your profit potential can go further to the upside, and you keep doing this. So recently we've had positions in silver and gold, and we've rolled them up a bunch of times. So even though the options are expensive, it justifies spreading. You don't want to just cut off your profit potential at, let's say, the first 15 points, and that's it, you're done. You can keep going to the upside. And here, every time you roll up, you're putting a credit in your pocket, and those add up after a while. So on the put side, same sort of thing. Let's say you wanted to be bearish. Here's SPY's at 695. I'm sorry, that's the next chart. There was one more chart here. I was just showing you the prices. The current prices on that call spread are 10.50 and 3.20. So the difference there is $7.30. So you're paying $7.30. You buy this one for 10.50. You sell this one for 3.20. It's a total debit of 7.30. You can max out at 20. I mean, that's nice. You'd like to max out at 20. But we can, by rolling up, do even better than that. But as a spread goes, or an option trade goes, that's okay. But you know, oftentimes you can do better. So here's the put spread I was going to talk about. So again, S&P's at 695, SPY's at 695. If we're going to do something bearish, we would buy a 695 put. In this case, when I looked at the prices this morning, it was about 820. And now here, remember, I said we spread these 35 or 40 points wide. So here we're going to spread it 35 points wide. We're going to sell this one for 220. So we're buying 820, selling 220. That's a total outlay of 6. But now we can make 35. So we're investing 6 to make 35. Quite a bit better. And again, we're still taking advantage of the skew in the puts, the expensiveness of the out of the money put. In this particular case, if SPY traded all the way down to 660, which is the short strike in this spread, then we move the whole spread down 35 points on each side. All right, so let's look at some individual put call ratio charts. This is Microsoft, and I noticed I showed you before that we had a buy signal in Microsoft on the modified Bollinger Band system. Well, here we also have a buy signal from the weighted put call ratio. Now, the last time we had a buy signal here, by the way, we only do the extremes when I'm dealing with stock options. I don't consider that little local maximum there to be a buy, or this one over here. I'm really looking for the extreme. So this was an extreme here, and that was a good buy signal. Well, we just gotten another one right here, and so so we're buying. We actually bought a spread in Microsoft because the options were expensive with earnings coming up, and now we see today that tonight the stock is down. So maybe even perhaps better opportunity. But what we would do at this point is see if the put call ratio continues to decline and supports the buy signal. So once we're in these, I'll stay in it as long as the put call ratio is declining. If the put call ratio were to turn around and go to a higher level like here, then I would stop myself out of the trade. Here's another one. This is a sell signal in the NASDAQ. NDAQ. You can see the local maximum and the extreme local maximum, local minimums are marked on this chart. And we have a new one here, extreme local minimum. That's a sell signal. But when I looked at the chart, you can see the stock has bounced a couple of times off this level. It happens to be 97. So we made this a contingent recommendation. If the stock closes below 97, then we will buy puts. Otherwise, we're not. So it just throws a little bit of extra technical analysis on top of the trade. This is a couple of pretty interesting ones. So the larger chart, the one in the background, is the original buy signal that we had in gold last November. The insert here, the little chart on the inside, this is that same buy signal in November, but now you can see what's happened since then. So here's that same buy signal, but now the ratio has come all the way down here, although it hasn't really rolled over and started to go back up yet. But what happens in a situation like this is we will start to use a trailing stop. If the thing has so much momentum, we just stay with the trade. We're running a trailing stop on this right now. It's been rolled up a bunch of times. We roll up every 10 or 15 points, and it's still cranking. In fact, today was, I think it closed up 20 or almost maybe 19. 18 and change. So just really, even before the Fed announcement, it was up, and then after the Fed announcement, it was up even more. We had a similar thing in silver. We had a buy signal last November, and yes, why am I having trouble with this? There, we had the buy signal on local maximum right there last November, and then inside the chart you can see where that's gone. Well, what's happened now in the chart itself, here's that buy signal. It has come down and rolled back up, so technically that's a sell signal, but because there's so much momentum here, we're just running a trailing stop behind this huge advance, and we've been rolling the options up every 10 points. We've been rolling the strike up every 10 points. There's another one. This is Bitcoin. Bitcoin is giving a buy signal here. The chart is on the bottom. This is one of the Bitcoin trusts, IBIT ETFs, but it's essentially Bitcoin. So Bitcoin trying to find a bottom here. This has given us a buy signal, and that we've got a local maximum on the chart. And there was a great one last April. One in September was not so good. So we'll see how this one turns out. But we also bought calls here. And then we can do this with futures options too. So in this chart, the bottom chart here, this put call ratio chart, is drawn using the T-bond options that trade on the Chicago Board of Trade. But you don't have to trade on the Chicago Board of Trade in order to take advantage of that, because there's an ETF, TLT in this case, that simulates the path of the long bond. So you can use the futures options to get your signal and then trade it with TLT, or if there is an ETF. On the other hand, something like this orange juice, which recently gave a buy signal, there is no ETF for orange juice. So if you want to trade these options, you have to trade them on the ICE. And frankly, I think some of the retail option brokers have stopped trading in orange juice options because they're just too illiquid and they've been too much of a problem. But in any case, if you did want to trade this chart, you would have to trade the orange juice options that trade on the ICE and find a broker who handles them. So let's move on to market breadth. Market breadth is just advances minus declines, and there's a number of things we can do with that every day. We can keep a running total, or we can create an oscillator. So in our case, we do create the oscillator. This is it right here, and the red areas are when the oscillator is overbought, and the green areas is when it's oversold. So this chart goes back to 2018, where most of the time, the stock market is going up, so we don't have too much in the way of oversold. Although we did, in this case here in 2022, when we actually had a bear market, we got oversold quite a few times. Anyway, most recently, we just barely got oversold in January, and we jumped higher, and then since then we've just been struggling to maintain this buy signal that occurred around January 9th. But you can see it's slightly overbought here, so that's good. I mean, overbought does not mean sell. So if we're long and the market's overbought, that means it's going up, and that's good. So far, that's been a positive indicator. This is a very short-term indicator, probably our shortest-term indicator, and it can swing back and forth. But when it when it hits one, it's a pretty good signal. So as I said, this is on a buy signal since January 9th. Now, overall, breadth has not been that great in this market, and some people have been complaining about it really for the last 6 months or so. But really, that's because the strength of the market is in the AA stocks and just a few stocks and not in all the stocks. But we have been seeing an improvement in breadth more recently. So maybe if we do finally get an upside breakout, we can get the breadth to improve if more stocks participate. Now, there's another thing called cumulative volume breadth. That's the volume on advancing issues minus the volume on declining issues every day, and then accumulated, just add that total up. This has made a new high, all-time high, 56 times since May 16th last year. And S&P has, of course, been doing similar. So this is real strong confirmation of the new highs in S&P. And in fact, this cumulative volume breadth made a new high just yesterday, January 27th. It can also be useful as a negative divergence at the start of a bear market. There's no evidence of that at the current time, though. This is how it looked last summer. So after the market had its big sell-off in April, cumulative volume breadth fell off as well, but then it recovered and made a new all-time high right here. You can see the S&P had not yet made a new high, and so you're able to buy S&P there and just make this, at least that part, because it typically follows along to a new high. And we calculate this in terms of New York Stock Exchange data, or what we call stocks only data, which is all stocks that have listed options on them. There's over 6,000 of those these days. New highs versus new lows is something we look at as well. We pay attention to the New York Stock Exchange figures there. This gave a buy signal on November 26th, which is shown in those two green boxes on the lower left, and that buy signal still in place. So this doesn't flip back and forth too often. It did there at the end of last year, but most of the time it gets on a signal, it pretty much sticks with it for a while. So it's sort of an intermediate term indicator, and it's doing very well right now. New highs have completely outnumbered new lows. In fact, new highs have been over 200 or 300 on many days recently. So let's talk about VIX. The trend of VIX is important, and typically VIX trends opposite to the stock market. And then spike peaks on the VIX chart are important too. So here's the current VIX chart, and all those B's are spike peaks. We have a very strict definition of a trading system we built around those, and the red ones are successful trades, the blue ones are unsuccessful. There's a stop out in that trade, and then the green one at the end there, that's the one that just happened. So we just had a buy signal last week when there was this trouble over Greenland, and the market dropped and VIX went up, and then it came right back down again and gave a spike peak buy signal. And by the way, that's a buy signal for the stock market, not for VIX. And then the pink B at the bottom there is the trend of VIX. In that circle area there, we show that the trend of VIX is it took a positive shape there because the 20-day moving average crossed below the 200-day moving average, and VIX was also below. So those are still in place, the spike peak buy signal as well as the trend of VIX buy signal. You know, VIX is low. That's not that low. It's like 16 or so. But people say, well, when VIX is low, it's time to go. That's not really true. It's when VIX is low and it starts to rise, that's when its problems happen. So VIX can stay low for a long period of time. It's just like another overbought condition. And the market can continue to go higher while VIX is low. So that's just because VIX might be low is not a reason for selling. So you can't trade VIX, but you can trade the futures. So if we look at the pricing of the futures in a normal bullish market, the term structure slopes upwards like this, and that's bullish. Sometimes though this happens, and the term structure slopes downwards. When that happens, it's time to head for the door, the exit. And here's where we are right now. This is where we were this afternoon anyways. And you can see that VIX itself was trading at 17, and the Fed futures, which are the front month, are trading at 1852. So 1852 minus 1707 equals 145. You can see each futures contract is higher in price than its predecessor. And in addition, they're all trading with a nice premium to VIX, and so all that's bullish. All that picture there is bullish for stocks. If you don't follow the VIX futures, it's very easy to do. They are quoted closing prices there on the CBOE website. The CBOE publishes 6 volatility indices daily. So there's a 1 day, which is pretty much useful for VIX 0-day expiration trading. There's a 9-day VIX. The regular VIX is 30 days, and there's a 3-month, 6-month, and 1 year. These are the current prices this afternoon. And again, you can see that each one is successively higher than the other. So those are all upward sloping term structure that's called, and so that's bullish. And again, bullish for stocks. So, you know, we had a little bit of an upset in what I call the construct of the term structures and all that last week when we had that tariff tantrum regarding the Greenland tariffs, and you know, nothing happened. So we're back to where we were, and what we're really watching carefully. This is Feb versus Feb. I should say Feb versus March. So we're watching the price of the Feb futures versus the price of the March futures. And if Feb were to rise above March, that would be bearish. That would be a problem. But this where right here is not a problem at all. So everything there is still bullish. So just a quick note, realized volatility had come down, but it didn't get down to 6%. If it gets to 6%, that's a little bit too low. That can generate sell signals, but that has not happened. So this realized volatility is sort of in a no man's land right now. So if we look at all of our indicators that we just talked about, The chart, so maximum bullish is all the way to the left side of this chart here, like over here. I didn't put SPX all the way over there because it can't seem to sustain an upside breakout, but new highs are dominating new lows. We have a VIX spike peak buy signal. We have a trend in VIX buy signal. Breadth oscillators could be better, but they're still bullish. Equity on put call ratio, we saw those were bullish. We just saw now that the construct was bullish. And the two things that we don't have a signal from right now are the modified volatility bands and realized volatility. But that's a very bullish picture, an almost maximum bullish picture. So, you know, things can change, but right now our positions reflect that. So when we get these signals from the various indicators, we do trade them, and we roll our positions when they become deeply in the money. So, you know, right now I'm still waiting for SPX to really confirm the upside breakout, but we're basically long and in line with those indicators. I mentioned a seasonal pattern. So starting tonight, at the close tonight and continue for the next 4 days, is a very positive seasonal pattern. Over the last 40 years, this seasonal has made money 31 times, and on average, S&P rises 1.1% over the 4-day period. So, you know, it's not a huge trade, but it's still 7 points on SPY or 70 points on SPX. So it's definitely worth trading. I mentioned now that our newsletter offer. So for members of this webinar, you can subscribe to our top 3 newsletters for a month each for a total cost of $99. Normally that would cost over $600. And the newsletters include, for example, in the Option Strategist newsletter, we just wrote an article about the importance of December lows, showing what happens if those lows are broken. Prior to that, we had an article on the Condor implosion that took place right before Christmas. It's called The Tragic Tale of Too Much Risk. And then the wheel strategy is kind of a popular strategy, but I'm really not a big proponent of it. We had an article about that as well. Our 3 newsletters are the Daily Volume Alerts, which comes out twice a day. The Daily Volume Alerts comes out once a day. The Daily Strategist comes out twice a day, and then the Option Strategist comes out once a week. You don't have to take these all at once. There's be too much information, so you can take them consecutively and see which ones you like. Obviously, the one that comes out twice a day is more expensive than the one that comes out once a week. So we're in our 35th year of publication now of the Option Strategist, and our track records are up on the website or in the newsletters. There is no guarantee, of course, performance will continue, but it's been good. And so you can also just go to our website, wander around if you feel like it. There's a lot of things on there. A couple of other things we have is a YouTube channel where I give a market update every Monday morning. We have a daily put writing newsletter in case you're just want some conservative way to write out of the money puts, and a special situation newsletter as well. So that's my contact information there. At the bottom is our money management contact information. If you're interested in money having us manage an option account, that's where to call us. Just be aware that our minimum account size is $100,000. So that's it. I'm going to wind it up and shoot it back to you here.